Are you looking for something better than the standard 60-40 portfolio? Well, maybe you're not. But if you're not, maybe you should. You know, the 60 is working, the stock, but the 40% that's in bonds are not necessarily working here. Bonds are underperforming, so we're getting less return than we did before. So clients can easily get weird, get itchy about holding these, paying fees for an advisor and thinking, you know, I'm really not happy that I'm holding bonds at 1.5%. So you as an advisor suggest other ideas for your client. You can show them where they can get a better return, perhaps from alternative investments. So today we're going to talk about alternative investments that you can show your client and your client can invest in confidently. Here are some of the characteristics and benefits of alternative investments. They can perform better than bonds during a yield downturn. They're a very dynamic asset class with a lot of wide range of options. They're becoming increasingly accessible to retail and individual investors. Harvard Business School expects the whole alternative space to grow by 59% by 2023, reaching almost 14 trillion in assets under management. So it's a substantial area. Knowing about them is only becoming more important. A few key characteristics is that they are illiquid, so expect illiquidity. There are some liquidity features, but it's more complicated than stocks for sure. They're uncorrelated, however, positively. They don't typically move in the same direction, so if stocks and bonds are gyrating around, the alternatives don't price in that same direction. They also have longer investment timelines. With a stock or bond, you can own it for a couple of years, you can sell it anytime you want. These have longer time frames, so you have to consider that. But now we'll get into discussion about what specific ideas that you can invest in. So before we dive in, I want to say a huge thanks to everyone who hits the like button and makes comments down below. It truly makes a huge difference for our channel. The more people that help out with the YouTube algorithm, the more will be pushed out to a brand new audience. Also, some quick background on this channel. I'm Brian Kasal and I'm the founder and CEO of FourStar Wealth Advisors in Chicago that manages over 600 million in assets with advisors across the country. My only goal here is to share everything I know to help you be a better financial advisor and to help you grow your financial advisor practice. We'll be sharing all the tips, tricks, and insights that I've learned over 37 years in this business. Please let us know in the comments if you have any follow-up questions about this topic. All right, let's get back to the topic at hand. Top reasons for you to consider alternative investments for your client portfolios. There is a sense of anonymity. As you buy a stock or bond, there's a registered record of you owning that bond. It only is on the record of the portfolio sponsor, so you have somewhat of anonymity and everyone doesn't know you own it. High potential returns. Since you're investing in a longer term investment, you can get potentially higher returns than you can in stocks or in certainly in bonds. There's also more choices. It increases the number of choices that you have that are in solid returns. There's often protection against inflation. The hard assets tend to outperform the market during high inflation. Diversification, obviously, it's an ideal way to diversify. There's special knowledge, and so you can invest where you have specialized knowledge or expert level knowledge. And then protection against market crashes. When markets severely damage the value in the short run in your portfolio, where alternatives are priced differently than stock markets. Here's how to get your clients started with alternative investments. Let's talk first about private equity and its capital invested into private companies. And the earliest investment you can make is in the early stage, what we call seed round investing, commonly called angel investing. Many of you might have seen the TV show Shark Tank. That's a very public view of angel investing, but there's angel groups all over the country that really literally buy off plans. They have investors make presentations to them with an idea. They may have a prototype, they may have a product, they may even have sold a few things, but usually it's a very small level and they need some money to go to the next round. This is the highest risk area of investing. It's also the highest return area, but many companies obviously never make it past this stage. So any money you take investing there could be significantly at risk, but nonetheless, every company starts out as an angel company originally. Then when they get up to the 1 million or so revenue level, they can go to the venture stage. And that's where many of the funds will buy into a company that's already beyond a level where they're at least cash flow positive and they're starting to make positive returns, but they still need capital to move to the next level before they might merge or go public or something like that. So that would be the venture stage. Venture funds are plentiful all around. They may have high minimums. There are some venture funds that have lower minimums and they're more diversified. There's a few programs that have been designed like that. So there's lots of opportunity in venture. It's more mature companies than early stage, but still growth companies on a very growth path, still very high risk, but nonetheless potential high returns. And then more mature companies that are growing before that they get into the potential stage where they'll sell to another private company or sell to another public company or go public themselves. Let's talk about private debt. So in the alternative space, one of the areas we get lots of interest in is in the corporate credit area, or sometimes called cash management, where there's short-term credit opportunities for companies that don't want to deal with banks or for some reason can't deal with a bank. Many purveyors have created corporate credit funds where you invest for a year or 2 years, or in some cases they have quarterly liquidity, and you can get a 5 or a 6% return, and that's better than currently the bond market will offer. Sponsor of that program may be getting a higher return and paying you that. Obviously everyone has to be able to make money at this, and so that's why they structure it that way. But usually the terms are shorter term, maybe maturities like a CD, but they are not CDs for sure. Then private debt also offers companies a way beyond the cash management level to have additional capital to grow the business without giving up equity. If you invest in private debt, you can make money in two ways, obviously, and the interest payments, and then of course repayment of the initial loan. So corporate debt, cash management side, or private debt in a little bit more mature structure are two really good ways to make more returns than a basic money market or a basic bond. Hedge funds are investment funds that trade liquid assets with the goal of a high return on investment. Those funds are usually only available to very high net worth investors with high minimums or to institutional investors. They will trade anomalies within the markets to try to make a better return, not necessarily making money in the markets, making money on the markets, if you will. Real estate is probably the broadest category of alternatives there are, including land, buildings, other structures. There are many characteristics that are similar to bonds, so real estate is often considered to be something similar to a bond. Valuation, of course, is a challenge because real estate is only worth what the next person will pay you for that real estate. There's a general valuation understanding based on cash flow. So the question is, how do we value real estate? Usually it's through income capitalization, discounted cash flow, sales comparables, and then how to become a successful real estate investor. There are many, many different ways: buying individual buildings, homes, multi-unit buildings, partnerships that buy multiple buildings. Commodities and futures and the options market, there are many ideas as well. Commodities go in wide cycles and haven't had a good cycle for many years, but we happen to be in a good commodity cycle right now. Mostly natural resources, agricultural products, oil and natural gas, precious metals and industrial metals have all shown some strength here where they haven't for many years. They're considered to be a hedge against inflation. They're not sensitive to the public equity markets. There may be companies in the public equity markets that own certain assets like this, but then sometimes it's a cost instead of a benefit to companies. So it depends on how much you use commodities. Value of commodities purely rises and falls with supply and demand for that commodity. It's not a new category. Commodities have been traded for thousands of years. We can go back to the tulip bulb scandals back in Amsterdam and Netherlands and Japan. They may have been the earliest formal commodity exchange in Japan in the 16th and 17th centuries. Mid-19th century, Chicago Board of Trade started commodities future trading. So there's lots of opportunities in commodities. Big category to talk about. Many investors invest in collectibles. They're purchasing and maintaining physical items in hopes for appreciation, from a rare wine collection to vintage cars, baseball cards, NFTs. I'm in scouting. Many people invest in scouting patches. So anything collectible that could be worth something more later on. It's often very fun to do, especially in an area you have an interest in, but it also can be risky. The high cost of acquisition of different investments in that category. There's no dividends, there's no other income until they're sold. Potential destruction of assets if they're not stored properly. So collectibles are a lot of fun, but there are some negatives, obviously, to managing collectibles. Structured notes are another interesting category, offered by major investment banks, often structured as a CD that has a participation with the market, say 60% of the upside and limited downside. So they're also very interesting to look at. But with all the good things, there are also some downsides to alternative investments. Here are the reasons not to consider alternatives. One would be long lockups. Sometimes it's hard to get out of long-term investments until they're sold. They can be very complex. They're difficult to value at times also. There's an unregulated market or partially unregulated market. And of course, we talked about liquidity. Liquidity is always an issue. So just to recap, alternative investments can be great portfolio diversification. They can lower your overall risk in your portfolio, offer you potentially higher returns, exposure to very unique investments others don't have access to. They have low correlation in many cases to the current portfolio, and they can be a really good hedge against inflation. So as alternative investments become part of the investing landscape more and more available to different types of investors, they're increasingly important for you to know about for your investors in the current space to help them with their returns, and of course to help you maintain your business and be relevant in that business for your clients and for your practice long term. So thank you so much for watching. If you enjoyed these ideas here, please smash that like button, as we always say, and subscribe to our channel and leave a comment down below. So don't forget to download our guide on how to get to 100 million and beyond in managed assets by going to FourStarWealth.com/advisors. And again, I wanted to reiterate that our only goal here is to help you to grow your financial advisor practice. So if you have any follow-up questions on this topic, any parts of this topic, please write them down, comments below, and we'll answer them directly. If you're a financial advisor looking for more freedom, higher margins, and better training, discuss joining our team by going to FourStarWealth.com/advisors. All right, thanks for tuning in, everybody, and keep on growing.